If you're enjoying this Which podcast, then you might also be interested in listening to other podcasts that we have to offer, like Which Shorts. Which Short is our weekly podcast that brings you a flavour of what the Which magazine has to offer, as well as our dedicated travel, gardening and tech magazines too. Each week we handpick a review, investigation or feature that was printed in one of our magazines and written by one of our award-winning writers. We then bring it to life on the podcast. So, to get a taster of what Which members get in our suite of magazines, be sure to listen to Which Shorts wherever you get your podcasts.
When life gives you questions, Which? Get answers.
Welcome to the Which Money Podcast, your weekly hit of money news and personal finance hacks to help make you better off. I'm Rob Lilly-Jones, sitting in for Lucia Ariano, and here's what's coming up this week.
One thing I'll mention here is, as I'm sure we'll get into for a lot of things, is the price is very volatile. So you'll see, big spikes, people's, investment has gone up huge amounts, but equally there'll be big drops in value where people lose everything.
There are some key kind of risks. We've talked a bit about volatility. There's liquidity risk as well. And what I mean by that is if you buy a share in, let's say, Vodafone, you can really easily sell that share at any point on the market. If I've got a piece of art or some fine wine, it's really difficult for me to do that.
Today on the show, we're talking about a topic we know you're always interested in, and that's investing. Although today, we are doing things slightly differently. Forget your investment funds and more traditional investment methods, because more and more people are looking outside of the mainstream and choosing to invest their hard-earned cash in lesser known and riskier options. So what's been driving this and what could be in it for you? Well, to answer those questions and many more, we are joined by Which Money Podcast regular, one of our own researchers and writers, Megan Thomas. Hello.
Hi.
Nice to have you back. And also joining us from AJ Bell, Laith Khalaf is the head of investment analysis. Welcome to you.
Yeah, thank you. Hi, Rob.
Brilliant to have you both. Thank you for joining. Now, Megan, I'm going to kick off with you. Let's talk about this rise in the number of people holding some form of investments, both usual, so the traditional methods, and unusual. Can you talk us through the numbers there?
Yeah, so kind of the main story here is the pandemic. We saw a huge rise both during the pandemic and that has continued after. So the Financial Conduct Authority have conducted this Financial Lives survey, so they check in every few years and ask some questions about different financial bits and bobs, and one of the questions is, do you own some kind of investment? So in 2017, the proportion of UK adults who held some type of investment was 32%. Mm-hmm. And then in 2020, that had gone up to 37%. By 2022, which is the most recent data, that figure had reached 41%. So it's a huge increase.
Quite a big jump relatively then.
Yeah, and so it's not just all investments, as you say, it's also these sort of real investments, so investments in tangible items, so things like wine, collectibles, even like fine art. That nearly tripled in that same time period, so 2017 to 2022. So in 2017, it was only 2.2%. And in 2022, it was 6.5%. So it's gone up massively. And even though it's small percentages, that works out as like 4 million people, something like that. So it's not a small amount of the population.
I definitely found myself buying more wine in the pandemic. Not for an investment, but...
So it might be unrelated.
Yeah, pleased to hear that I wasn't the only one. Laith, just to frame this entire episode, why do people choose to invest rather than, say, keeping their money in like a regular savings account, for example? Why would investing be so attractive to some people?
Well, we should first of all definitely have an audit on that wine selection to see how much of it is left nowadays. But yeah, the basic premise of investing, really, there are lots of reasons why people invest that motivate people to invest. Probably a key one is investing for retirement. You've also got kind of more medium-term goals that people might have, like school or university fees. Some people might just be building up their financial resilience. And the reason people do that through investments rather than cash is because over the long term, you can expect investments to produce a higher return. Now, it's not true year in, year out, but given a long enough time frame, your investments should outperform cash, and they should also beat inflation. And that's a key thing that you can't always expect for cash. So if you look at the Barclays Equity Gilt study, which is a very long running study of asset returns, they show that if you're invested in stocks. So they've looked back to 1899, so quite a long data set. So if you're invested in stocks, then your average annual real return, which is above inflation, has been 4.8%. If you're invested in cash, you have beaten inflation, but your annual real return after inflation is 0.5%.
And I suppose one for you both as well, actually, just to throw this one in there. Do we think, obviously, Megan, you mentioned those numbers, the number of people that are actually investing in some form has risen quite dramatically over recent years. Is that because there is better education out there, or is it now easier to do than it was previously, or maybe a bit of both?
It probably is a bit of both. I think a lot of the ways that people are investing, I mean, as we'll see as we go through these more unconventional methods, I think a lot of that is changing. So we're seeing a lot of the drive in the pandemic was young people getting involved, and they are engaging in these riskier forms. It's more like day trading and stuff, which is it's not this same sort of steady investment for retirement. So I don't know if it is necessarily financial education. I guess we haven't got that research to prove it, but I think it will be a lot of different factors.
And Laith, are you finding that as well?
Yeah, I'd like to hope that some of it is financial education. I think the other thing is, I mean, people genuinely were bored during the pandemic, and that was definitely the case. People were doing crazy things. I don't know if you remember, but there was that huge meme stock craze. People were, it took off in the US, but it was over here. People were just buying shares because hedge funds had shorted them and they wanted to take on the man. So they were just like throwing loads of their own money at this. And, in a lot of cases, probably losing lots of money as well. We also at the time had a huge boom in crypto. Again, people sitting at home thinking, I can make a lot of money from crypto, which you look at the kind of returns from crypto, you've got a lot of people saying I've doubled my money, which is not something you can really do within a couple of years from the stock market, really. So people are like, well, I'll have a bit of crypto as well. Thank you very much. So I'd hope that there is like a core of people who are becoming more educated. But I think particularly through that pandemic period, there was also just a bit of just human craziness going on and people doing new things. And maybe they'll get through those things and learn from their mistakes and end up being those kind of more financially experienced people who do kind of put money into more traditional assets as well.
When it comes to traditional investing then, is there a barrier to entry? We've said more people are doing it, but do people need a certain amount of money to access investments? And might that make some of these more unusual options seem more appealing to some?
Yeah, I actually don't think so, because actually now it's pretty easy to invest. I mean, you can do it from as little as £25 a month in most places. You can do it online via a mobile app. I'd actually argue that it's kind of more difficult to invest in sort of unusual assets because, things like, I guess, coins and art and wine, you have to go and find those out.
So traditional may be easier, but that doesn't mean that people aren't investing in these less mainstream investment options in increasing number. Let's dive into them then. Let's talk about some of them. We've mentioned them already. Let's start with small businesses, actually. This isn't something we've mentioned, but Megan, for a lot of investors, choosing to invest cash in a publicly listed company is fairly normal. Small businesses, is that different?
Yeah, so as you say, like big publicly listed companies is kind of the bread and butter of investing. And it's what most people, I mean, they're either doing it through a fund or directly in companies themselves. But it is different, with either private companies or small companies. So you just can't do that in the same way. So some will be listed on the alternative investment market, which has more lax regulation. So already, to get started, it's already a bit riskier because the regulation isn't as tight as it might be on the FTSE 100 or something. But you can invest in private companies through something called venture capital trusts, or VCTs is somehow some people get into that.
And this, what did you call it? Alternative
investment market.
Alternative investment market. How does that work? Does a company have to apply to be on the alternative investment market, or is anyone on there?
You get listed in the same way.
You still get listed, yeah. Laith, you're nodding along, yeah?
So the AIM market, it's known as the junior market of the London Stock Exchange. So it's run by the London Stock Exchange. So it is largely smaller companies. And because of that element, they do tend to be more volatile and risky. And also there is that, element of scrutiny, with the bigger companies, there's a lot of eyes on them. So, there's not quite as much chance of, something going wrong and nobody spotting it. Okay. So, something goes wrong at BP or Lloyd's, it'll be splashed all over the papers pretty quickly. Whereas, a smaller company, that's not necessarily going to be the case.
And when we talk about risk there, especially with small businesses, presumably the risk is what? That company goes under and therefore your money goes with it?
Yeah. So, I guess with smaller companies, you have, fantastic growth potential, but equally, compared to bigger companies, there's a big failure rate because obviously not everybody can make it. That kind of, means that actually when you're investing in these smaller companies, you have to take on board that risk. And also probably you do have to have a diversified portfolio, because if you just go for one or two and they happen to be the ones that fail, then, you're not going to get a good return on your money. And it's kind of probably an area where I think you're probably best off going towards kind of active fund managers who kind of run this for you, because they do a lot of research on these areas. And because they're less well researched, actually an active fund manager can probably get an edge here. Whereas so many people are looking at, Apple and Tesla, actually kind of what extra, knowledge can you really glean about those companies? Whereas actually kind of a small company that's starting out, potentially you can. And so I think it is an area where active fund managers can really come into their own.
But I suppose a key principle then to everything that we're talking about today, especially with these unusual investments, you mentioned it there, Laith, with fund managers, it's so important to have somebody there for you who really does know the market and knows exactly what they're doing. And that goes for any type of investing.
Yeah, I think so. And one of the basic tenets of investing, which is championed by, Warren Buffett, is don't invest in anything you don't understand. He didn't invest in technology stocks for an awfully long time. And I'm not talking about modern technology stocks. I'm talking about things like Polaroid and Xerox back in the 1960s when he started investing. So, he says, don't invest in it if you don't understand it. And I just think that's a really good maxim.
Well, on don't invest in it if you don't understand it, that Warren Buffett quote, cryptocurrency. Megan, it's something we've spoken about on the podcast many, many times. It's becoming more mainstream. We've spoken about it here on the Money Pod before, of course. Can you give us a brief explainer so we're all on the same page?
Cryptocurrencies are a form of currency, obviously, that aren't controlled by any country or central bank. So that's what people often say, it's a decentralized, that's what it means. It's not tied to any country. In theory, you can use it to buy and sell items, just like any other currency, but obviously not a lot of places accept it. That might change who's to say.
There's a burger restaurant not that far from where I live called Crypto Burger, and I'm pretty sure you can pay for your burger with cryptocurrency.
Well, there you go. So some do. But yeah, so there are different types of cryptocurrency. So Bitcoin, the most famous, is just one type of. They're not used interchangeably, and you can buy these different cryptocurrencies on places called crypto exchanges, which are sort of websites built up for that, and store them in digital wallets. So one thing I'll mention here is, as I'm sure we'll get into for a lot of things, is the price is very volatile. So you'll see, big spikes, people's investment has gone up huge amounts, but equally there'll be big drops in value where people lose everything. And that's kind of coming primarily from the fact that your investment isn't really backed by, it has no intrinsic value like other investments have, where if you invest in a company, it's about the performance of the company, it's about their sales and things like that. Crypto doesn't have that, so that's what makes it so volatile.
Despite those risks, it is becoming increasingly popular, isn't it? So the stats, do they back that up?
Absolutely, yeah. That same FCA survey that I mentioned at the beginning, they found that cryptocurrency ownership has also almost tripled since 2017. So it's 2% in 2017, 5.8% in 2022. So again, That's around 4 million people.
So you mentioned the FCA there, so this is the Financial Conduct Authority.
Yes.
Regular listeners to the pod will know that already, of course. But part of the risk of crypto, Laith, is that actually it's not regulated by the Financial Conduct Authority as many other, obviously, forms of investing would be.
Yeah, I think it's increasingly becoming regulated. So it started off from a place where it's not regulated at all. It's now kind of people who are kind of operating in the UK, selling to UK customers. There are certain rules that they do have to abide by, and slowly it is becoming more within the kind of regulators' ambit. So I think there is kind of increasing regulation, but that's not to underplay the problems that we've seen in the market. There was the FTX scandal where a lot of people lost a lot of money, not just because the cryptocurrency was being volatile, but because the company that was providing a platform for them to trade cryptocurrency was doing strange things with their money, which ultimately meant that they were investing it. The investments didn't go well and they didn't have the money to pay the people back. So, there have been problems there. Also, obviously, the kind of FCA regulation is, relates to kind of, UK customers and UK firms and overseas firms. But equally, you could quite easily set up something online where you're kind of setting up some sort of kind of Bitcoin offering, and not really be on the radar because maybe you're doing it from overseas. And I think this is an area where you can get a lot of scam activity, not necessarily from Bitcoin, maybe a bit from Bitcoin, because scammers are just drawn to areas that are really flashy and popular with people, and where people think there's lots of money to be made. So possibly Bitcoin, but particularly other coins. Perhaps getting marketing, say we've just launched this coin. You can buy in, for $1. Who are you sending this money to? What is this crypto coin? They're actually taking, hard cash off you in pounds and dollars. And what are you getting in return? You're this strange token. So I think it is an area where you have to be really, really careful.
Can I just add one thing about scams as well? Is we see a lot of fake celebrity endorsements. So that's I think an easy one to flag. It's often Martin Lewis. I've seen like Jeremy Clarkson, and they're like, oh, they love this this crypto. No, they don't. Yeah. That's not real. If you see any celebrity endorsement, like red flag, don't go near it.
Well, I should say on scams, of course, we do have our own Scam Alert newsletter here at Which. So we'll pop a link for how you can sign up to that in the description for today's show. And also, just to reiterate, because of some of the stuff that both of you have said there, here at Which, we do not advise investing in cryptocurrency due to its volatility. Now, after the break, we're going to be looking at more investment options that you may not have considered. And we'll also be taking you through the questions that you need to ask yourself before investing your hard-earned cash. So all that's after this.
Want to stay ahead of fraudsters and across the latest scams? At Which, we helped prevent an estimated £1.8 million in scam losses last year thanks to our Scam Alert newsletter. And each week we provide more information on the latest scam activity, helping protect you, your family and your friends. Stay in the know and avoid falling victim to scammers by joining over 450,000 people already signed up to our free Which Scam Alerts. To join them, head to which.co.uk/scamalert and sign up today.
Welcome back then to this episode of the Which Money Podcast. And before the break, we were looking at cryptocurrency. But now let's look at a currency of another kind, and that's physical coins. Now, admittedly, this seems a bit bizarre to be talking about them in 2024. I don't remember the last time that I had some physical cash in my wallet. But Megan, we're not talking about that kind of money, are we? We're talking about coin collecting. It's more than just a pastime for some people.
Yeah, for many, it is just like a beloved, national hobby. But there are lots of people that we hear from that are, looking to actually make money from it. So as you say, it's not really the kind of coins that you see in circulation because they're not rare enough. I mean, maybe if we were dead for a few hundred years, they'd gain value, but we'd be dead, so it wouldn't be very helpful.
If you pass on a pound coin that you have now to your great granddaughter, maybe but she might have a chance.
It's not that type of coin. So like the rarest coins in the world have sold for millions. This is the sort of, you go to auctions, and like with cryptocurrency and small business, you need to know what you're talking about. You need to understand the coins. Otherwise, you're just going to kind of get ripped off. Buying coins that actually aren't that rare.
So we often see, don't we, sometimes these special 50p pieces. They're produced by the Royal Mint, who obviously are the ones behind the currency in the UK. But Paddington Bear's been on some 50p's, Peter Rabbit. I mean, are we talking about these kind of things? We're not, are we? These aren't going to get you, like you said, the hundreds of thousands or millions that you just mentioned.
No. I think this is where a lot of the misconceptions are, is because it's like a special edition. Like, oh, that's going to be valuable. It's a collector's item, but it's not really aimed at resale. Like, you could see some of these coins going for huge resale prices, but on sites like eBay. So to use the Paddington Bear example, because I found one of the Paddington Bear 50p's, I was like, oh, I'm rich. You
found one of them?
So I was like, oh, I'll look it up. And then like on eBay, like £10,000, oh, I'm rich, I've done it. That's obviously not like people just, you can put something on eBay for any price. It's not an accurate view of how much something is worth. So it's probably because there's about 9 million of them in circulation. They only got put out 2019. It's about maybe £1.50 if you're lucky.
So the fact that you are still talking to us now means you didn't get
it's
10.
A bad sign.
Didn't get 10 grand. No.
But yeah, so it's a hobby, like that. Those types of coins, it's not about making money, and you'll be let down. You'll be putting in a lot of effort to get very, very small profits. So it's not worth it from that angle.
Well, I'll take your Paddington Bear 50p, and then I'll raise that with bullion coins, Laith. What are they? What's the landscape like as well for those at the moment?
Yeah, so I mean, what we're talking about here is kind of really investing in precious metals, and probably the most well known is gold, which you can do through a number of avenues, and one of them is buying bullion coins. So gold at the moment is pretty much near a record high. Gold tends to thrive in times of economic, political uncertainty, and we've got plenty of those at the moment. So we've seen the gold price. It's now around $2,400 per ounce. Is it a good time to buy in? Well, it's quite a lot of the time when an asset hits a record high. Actually, it's probably time to start thinking about taking profits. But with gold, it's a bit of a conundrum, I always think, because it's not unlike Bitcoin. There aren't too many real world uses of it, right? So Bitcoin's often called digital gold, but if you think about it, kind of a lot of kind of industrial uses exist for metals, for iron ore, for copper. But gold is really, you're just passing it on to someone who's investing in it, and you're hoping that they're going to pay more for that asset than you paid for it. And again, I'm going to quote Warren Buffett again. Well, actually, this is attributed to Warren Buffett. I've never actually found a source for it, but he says, it's a funny thing about gold, because we spend huge amounts of money digging it out of the ground to just transport it and just put it in a vault under the ground again. Actually, it's a really strange economic activity when you think about it, isn't it? But it does have a very long history, and unlike Bitcoin, and it is widely accepted by investors who use it as a form of portfolio diversification. So I think if you're doing it for those purposes, it's perfectly fine, because it acts a bit differently to everything else. I'd probably say there might be better ways to do it than to use bullion, because bullion, it's probably quite difficult to trade it, and you also have to store it, possibly get insurance on it if it's held in your house, possibly get a bank vault if you've got enough of it, right? But you can actually buy gold, physical gold, through what are called ETFs, exchange traded funds, and you can actually hold those in pensions and ISAs as well. So you can actually protect it for your gains from tax. And I think actually as a bit of a bit of something different in your portfolio, I think it works if you've also got shares and bonds. I probably think we're talking about maybe 5 to 10% of an investment portfolio at the most. And, I think you can get away without investing in gold in your entire investing life. But if you do think, well, you know what, I would like to have something that's doing something a little bit different in my portfolio, then you might think about adding a bit of gold.
Well, before we finish today's episode, I'll be asking you both your investment tips to leave us with. So I'm sure, Laith, you'll have some more nuggets, no pun intended, there before the end of the episode today. And Megan, obviously, as with so many of the things we're talking about, scammers also operate in this area, right? Because, how do you make sure that what you think you've bought, that bullion coin you think you've got, I mean, is there a form of sort of accreditation out there so you know what you're buying?
Yeah, so I mean, if you did decide to go down the bullion coin route, which does have its issues, as Laith mentioned, you'd need to get it from a royal mint, either here or of a different country. But it is harder to resell those. So I would say easy ways to avoid scams: don't respond to kind of cold calls or anything like that. If they're telling you guaranteed returns, that's not to be trusted. But yeah, so going through these legitimate companies that are providing ETFs, while there is, the risk of the value going up and down, the risk of scams is much less there.
You at least know what you're buying in that case. No, that makes complete sense. Now, finally, then, let's focus on our fourth and final unusual investment on today's show, and that is fine wine. Is there actually money to be made from investing in fine wine?
Well, not to sound like a broken record, but if you know what you're talking about, then yeah. It's, again, if you have the expertise, maybe. But it's not something that's going to be an easy way to earn money, or necessarily a reliable way to, especially if you're a beginner, to get money. So
and this isn't like, you're not buying an expensive bottle off the shelf in Waitrose and hoping that that'll increase in value.
No, I wouldn't recommend that. So yeah, most wines that you buy in a supermarket, if you just kind of hold them for a long time, they're going to completely spoil much sooner than a fine wine, and you've got something completely worthless. So yeah, these are fine wines. So there's actually an index that tracks the value of the 100 most sought after fine wines on the secondary market. So, and they've got some stats about the returns. So over the last 5 years, this index has returned 13.6% on initial investment. But it is like all the other things we've talked about, it's quite volatile. So if you'd invested 2 years ago, you'd have lost 14.6%.
Wow, okay.
So even if you do know what you're talking about, there's volatility there, but it's definitely not something to invest in if you haven't got the expertise. You'll not get much better returns, if good returns at all, than just investing in stocks and shares or investment funds.
And Laith, am I right in thinking HMRC can get involved in fine wine as well?
Yeah, I mean, I think they can get involved in all these assets, and it's really important that you don't assume that there's no tax to pay on any of these, depending on what asset in particular we're talking about. There will be different tax implications, and I know in particular HMRC is really keen to clamp down on crypto, because so many people hold it. There's probably a load of undeclared gains out there, which government finances being what they are would probably go down quite well at the Treasury. So definitely there's that tax element. I think just thinking about the other things with all of these kind of these collectible and unusual investments we've been talking about, there are some key kind of risks. We've talked a bit about volatility. There's liquidity risk as well. And what I mean by that is if you buy a share in, let's say, Vodafone, you can really easily sell that share at any point on the market, right? I can sell it, buy it back, sell it, buy it back, sell it, buy it back all today. If I've got a piece of art or some fine wine, it's really difficult for me to do that, right? So I can't do it instantaneously, and I might not be able to find a buyer quickly. So there's that kind of liquidity risk which applies to all this stuff. There's also costs involved. So if I'm selling my fine wine, I'm going to have a broker sell it for me. If I'm selling my coins, how does that all fit in? I mean, how much does that take off your returns as well? So really important that you're looking at costs. And I would also say the costs, again, we've mentioned this, I think, but the ongoing costs of storing these things, again, for wine, if you're keeping wine in kind of in your garden in the sunshine, it's not going to keep very well. So you might even, if you've got a very expensive wine, you might think about keeping it in a kind of properly maintained professional warehouse that has costs. If you're keeping art at home that's very expensive, you've got to think maybe about adding it to your home insurance. So there's lots and lots and lots of things that you do need to think about, and which is why I always come back to that. If you're interested in this stuff, fantastic, go buy it. But please don't bet your pension on it, because there are better ways to save for your retirement. If you can make some money, great, but just enjoy yourself is probably the main thing that you should be doing.
Don't bet your pension on it, I think, is a very good thing to live by. Before we wrap up then, maybe you've listened to this as a hardened investor, but actually maybe you've listened to this as someone who's never invested before. So let's talk directly to those people then. If someone is investing for the first time, Megan, what advice would you give them?
Yeah, so I mean, we've obviously talked a lot today about risk. So getting to grips with what risk is right for you, not just sort of personally, what can you emotionally handle, but also like what are how long term are your goals? Are you maybe needing to take that money out in the next 5 years? That's going to change, how risky you want your investments to be, as opposed to maybe you're still quite young and you're looking to start investing for your retirement, so you can take a few more risks. So that's a really important thing to think about. And then I would say getting stocks and shares ISA, which most of the investments we talked about, you can't put in a stocks and shares ISA. So what that will do will give you £20,000 to invest tax-free each tax year. So that's April to April. And within that, finding the right provider for you for that ISA. So one of very few sort of guaranteed ways to improve your returns is to cut down on unnecessary fees. So luckily for you, lovely listeners, we've got reviews of different stocks and shares ISA providers online. So finding out who's got the best customer service, the lowest fees, and finding, what's right for your level of expertise. If you're a beginner, some platforms are specifically designed for that. If you're more confident, you want a platform that's going to give you the full range of what you can invest in. So I would say that's some things to get started with.
And we'll make sure we pop a link to those reviews as well in the description for today's show as well. And Laith, maybe, I don't know if you want to touch on more experienced investors and maybe what they should potentially do. Maybe they're looking to diversify their portfolio, as you mentioned, is vitally important.
I always come back to kind of three main points, really, which is when investing. One is just keeping that long-term view in mind, not overreacting to kind of short-term movements in the market. The second is consider regular investing, because it takes all the emotion out of it. It just goes out of your bank account. It's a really disciplined way of investing, and it happily means that you even out the kind of ups and downs of the stock market, because you never push all your money in just before there's a crash. You also don't, push all your money in just before there's a big rise. You get a nice, even, smooth journey. And the final thing, which kind of Megan touched on there, is just make sure it's invested as tax efficiently as possible. So there are vehicles like ISAs and SIPs, which allow you to hold your assets and keep your gains free from capital gains tax and income tax. And over your life, that can actually add up to a substantial amount of money that could be in your hands rather than in the hands of the taxman. So I think those would be my 3 points that I'd kind of conclude on.
Some fantastic advice on today's episode. So Megan and Laith, thank you so much for joining us.
Thank you.
Pleasure. Thanks for having me.
Well, a huge thanks again then to Megan and Laith for coming on the show today, and to you as well for listening to this week's episode of the Which Money podcast. If you enjoyed today's show, as ever, then please do hit subscribe to make sure you catch our new episodes as soon as they drop. And for daily money news and advice, don't forget you can find us on social media. We're at Which Money, and we're also online at which.co.uk/money. And we've got our free money newsletter too. That's delivered to your inbox every Monday, and to sign up, you can visit which.co.uk/money newsletter. This episode of the Which Money podcast was written and presented by me, Rob Lilly-Jones, and produced and edited by James Rowe.
If you're enjoying this Which podcast, then you might also be interested in listening to other podcasts that we have to offer, like Which Shorts. Which Short is our weekly podcast that brings you a flavour of what the Which magazine has to offer, as well as our dedicated travel, gardening and tech magazines too. Each week we handpick a review, investigation or feature that was printed in one of our magazines and written by one of our award-winning writers. We then bring it to life on the podcast. So to get a taster of what Which members get in our suite of magazines, be sure to listen to Which Shorts wherever you get your podcasts.